we are diving into indexed universal life insurance for the national portion of your life insurance exam. On the exam, you need to recognize that Indexed Universal Life, or IUL, is a permanent life insurance policy that allows the cash value to grow based on the performance of a stock market index like the S&P 500 without the money actually being in the market. This is the first trick the exam will throw at you. They will try to make you think the policyholder is directly invested in stocks. They are not. Instead, the insurance company uses a formula to credit interest based on how that index performs over a specific period. One of the most critical concepts for your test is the relationship between the floor and the cap. The floor is the minimum interest rate that will be credited, which is almost always 0%. This means that if the S&P 500 drops 20% in a year, the policyholder loses nothing from their cash value due to market performance because the floor stops the loss at zero. On the flip side, there is the cap, which is the maximum interest rate the company will credit regardless of how high the index climbs. If the market goes up 15% but your policy has a 10% cap, you only receive 10%. You are trading the unlimited upside of the market for the protection of the floor. Another term you must know is the participation rate. This is the percentage of the index growth that will actually be credited to the policy. If the index grows 10% and your participation rate is 80%, you will receive 8% interest. The exam will often ask about the licensing requirements for selling IUL, and this is a major trap. Because the policyholder is not directly invested in the stock market and the insurer guarantees a minimum floor of zero, IUL is considered an insurance product and not a security. Therefore, you only need a life insurance license to sell it and not a securities license or a FINRA registration. This is the exact opposite of variable universal life, where a securities license is required because the policyholder assumes all the investment risk. When thinking about indexing methods, remember that companies might use annual reset or point-to-point methods to calculate gains. To help you remember the core mechanics of IUL, just use the phrase interest under limits. This reminds you that the interest is tied to an index but is always subject to the limits of the floor and the cap. Look out for questions that suggest IUL has a fixed guaranteed interest rate like whole life. It does not. The interest is flexible and depends on the index, though the floor provides a safety net that separates it from riskier variable products. Like standard universal life, IUL allows the policyholder to adjust their death benefit and their premium payments. You can increase the face amount if you provide evidence of insurability, or you can lower it to fit your budget. The cash value is what pays for the cost of insurance inside the policy. So as long as there is enough money in that cash account, the policy stays in force. On your exam, you might see a scenario where a client wants market-linked growth but is terrified of losing their retirement savings in a market crash. The examiner is looking for you to identify the 0% floor as the primary solution for that client. Another area of confusion is the difference between a cap and a participation rate. A cap is a hard ceiling, while a participation rate is a percentage of the total movement. Always apply the participation rate first, then check if it hits the cap. Remember that IUL is still a form of universal life, which means it is transparent. Policyholders receive annual reports showing the exact cost of insurance and the administrative fees. If you see a question about which policy offers transparency and market-linked interest with a floor, you are looking at IUL. Do not let the word index confuse you into thinking it is a variable product, because the insurer keeps the money in their general account and assumes the risk of providing that floor protection.